Hello, this is Edgar Arceo. Today's episode is about creating a college fund for children using a 770 account or a very well-structured life insurance policy that parents can also use for retirement purposes. As you will see, this is a win-win for everybody, not just the child. Last month, I talked about getting a 770 account for a baby. So in today's episode, I'm going to be using the same policy structure. As many of you know, my baby girl was born 4 months ago, and we decided to purchase a very well-structured life insurance policy for her. So the question is, how can that policy be a college plan, and how can I, as the parent, use that for my retirement plan? Stay tuned. Okay, so we are using the example from last month, opening a very well-structured policy for a baby with an annual contribution of $5,000. Now, some of you may think that $5,000 is too much to save for college, and some of you may think that is not enough. So for all of you that may think that $5,000 is too much to save, just think this will also be your retirement plan. And in actuality, you will be able to finance things through this policy as well throughout your life. But that is another topic for another future episode. Of course, if you don't have the means to save $5,000, you can always start with less. Remember, something is always better than nothing. Now remember, this is not a 529 plan. So if my daughter ends up not using the funds for college, she or I will be able to use the money for anything else, like buying her a car without paying taxes and or penalties like you would with a 529 plan. So let's quickly review how this can be used for my daughter's college education, and then we will jump into the fun part. That's my retirement. So at the age of 18, I will have $158,000 in my daughter's policy. At that time, if she hasn't received a scholarship, most likely she will, I can already tell, she can apply for a student loan. This is so we can let the money grow inside the policy for 4 more years. Since the cash value inside the policy is not currently recognized in the FAFSA application, this will allow my daughter to qualify for more financial aid than if the money had been invested in another funding vehicle. So she can go ahead, apply for the loans needed, and wait until graduation to pay those loans. Federal loans don't charge any interest until after graduation. So let's say that she graduates at the age of 22, and at the age of 23 we decide to pay off all the loans. Let's say that each year it will cost her $40,000. So that multiplied by 4 years, that is $160,000. So after paying the student loans, I will have about $60,000 left in the account, growing at a rate of about 7% tax-free. So that is a good little retirement account for me. But that is not the end of the story. It is just the beginning, because now I have created a storehouse of wealth where I can store more money that will grow at a very good rate with no risks and tax-free. What do I mean by that? It is very simple. This policy will work like a savings account, with the difference that this account will give me, instead of a pitiful rate of 0.03% that regular banks give, which by the way is taxable, it will give me a rate of 7% and it is tax-free. This is why some people say that this 770 account will give you 100 times more than a regular bank, although in this example is 233 times more. So if I have some money sitting somewhere, I can now transfer those funds to this policy knowing it will give me a very good rate of return tax-free. And also, if I'm saving money for other things like vacations, emergency funds, etc., why not use this policy to safeguard my money? For example, let's say I'm saving $600 per month for retirement, $50 per month for unexpected events, $100 for other purposes. That is $750 per month, which means that I can save $9,000 per year.
So let's have some fun, put those numbers in the policy, and analyze the results.
After taking the $160,000 to pay for college, I will be saving $9,000 per year. If you do the math, you can see that the cash value will grow at a very competitive rate of return, tax-free. In this example, I, as the parent, will be retiring after 15 years of saving $9,000. That is $135,000. But the cash value grew to $386,000. Now it is time to retire. This policy will allow me, as the father, to complement my retirement by withdrawing $25,000 per year. I'm going to do this for 20 years, for a total of $500,000. And remember, all this income will be tax-free. Can you calculate how much I will need to pay in taxes otherwise?
So let's say that I die after 20 years of taking this passive income of $25,000 a year from this college plan.
There is still $265,000 of cash value that my daughter can use for her retirement. She will do the same thing I did. She will take advantage of this storehouse of wealth to put some money there with no risks. So just to keep it simple, let's say that she saves $10,000 per year for 13 years until age 70. And then she starts taking a passive income of $10,000 for the rest of her life. Let's say that she dies at age 86. At that point, the death benefit will kick in and the policy will deliver $1.3 million to my grandchildren, all of it tax-free.
This is truly a financial plan that creates a generational wealth. This will be a huge financial blessings to at least 3 generations. And a Bible verse comes to mind. In Proverbs 13:22 it says, "A good man leaves an inheritance to his children's children." The great thing about this plan is that if you start early enough, like I did, you're going to be able to bless your children and your grandchildren without much effort, while benefiting from it yourself too. This is really a win-win-win situation. Also, please note that all these numbers are based on the 2016 dividend scale of the life insurance company. I want you to know that 2016 has been one of the lowest dividend scales for all these mutual life insurance companies. This was caused because of the very low interest rates in the economy. It is my personal opinion that in the next 3, 4, 5 years, the interest rates will go up. If that is the case, the life insurance company will be able to pay a better dividend scale. And if that happens, the results will be more favorable than what I described in this video. So this is how you can create a generational blessing for a true financial legacy. If you have any questions, please send us an email or give us a call. Thank you for watching and God bless you.